Corporate Finance Excel practice problem. In this presentation, we're going to work a practice problem in Excel related to multiple ratio calculations. This will be a bit of a compilation of different ratios we will be calculating, including the current ratio, the quick ratio, the debt to total asset ratio, the asset turnover ratio, the average daily credit sales, average collection period. It'll be great. Get ready, because it's time to take a chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side, calculating the current ratio, the quick ratio, the debt to total assets, the asset turnover, the average daily credit sales, so we can calculate the average collection period. So we're going to go back on up top. Information on the left includes some income statement information, including the sales and the percent of sales sold on credit. And then we have the balance sheet information. We have an entire balance sheet here, including the assets, cash, accounts receivable, inventory, plant and equipment, total assets. So we kind of broken this down. There's not as many subtotals here, but we got basically the balancing concept of the balance sheet with the total assets and the liabilities and the equity. Liabilities and equity, including the accounts receivable, accrued taxes, bonds payable, common stock, paid in capital, and retained earnings. So that's going to be our balance sheet. We're going to use that information in order to calculate some of our ratios, including the current ratio. So let's start off with the current ratio. Very common ratio for liquidity type of calculations. We're trying to see whether or not the company can pay off their current liabilities. And typically we will do that by comparing current liabilities and the current assets. So, and this is going to be common for something like a banker or someone like that's investing. They want to see if the company is going to be sustainable in the short run. To be sustainable, they need to be able to pay off their debts that are coming due in the short run, which include the current liabilities. And that's the reason why on the balance sheet we break out between current assets, long-term assets, current liabilities, long-term liabilities, so that we can look at that range. Current liabilities, you'll remember, are simply those liabilities that are going to be due within a year's time period. Therefore, most urgent liabilities and the ones that we need to make sure that we're going to be able to cover with the current assets. Now, when we break out the balance sheet such as this without the subtotals, so we don't see the subtotals of the current assets and liabilities, and we don't see the breakout between liabilities, current liabilities, long-term liabilities, and the equity section, that forces us to then go in and say, okay, what is included in current assets? What's a long-term asset? What's a current liability? What's a long-term liability? And what then are the quick assets, which we'll talk about next time. So current assets, if I go through this, the assets are typically going to be in order in terms of their liquidity, and the more current assets will be on top, right? So cash is going to be the most liquid asset because it's the thing that we can use to purchase most easily. Then the accounts receivable, we expect them to turn over quickly. Then the inventory is going to be a current asset. Then we get down to the property, plant, and equipment. Those are depreciable assets. Those are long-term assets. I'm not expecting to consume those at any time soon. And I can't really use them in order to pay our current obligations. And so we're going to be taking these three items. I'm going to use the sum function to do so. So I'm going to go in cell E2, I'm going to say equals, and then the sum function, I'm going to say control or like shift 9. And then I'm going to use my arrows to go on back over here. And then I'm going to hold down shift, down, down. And then you could close it up, or you don't have to. If it's just the sum function, the system will do that for you. You can, of course, use the mouse as well. I'm just, using the sum function a little bit faster with the keyboard. If you use the keyboard, it's going to be a bit faster. We're going to go to the liabilities then. Current liabilities, same kind of thing. We're going to go, okay, which of these liabilities are current? Accounts receivable is current. That usually represents, or accounts payable is current, usually representing payables we have for normal type of business transactions, often for the purchase of inventory. It's going to be due within a year, therefore current. Accrued taxes, typically going to be current. Those are accrued taxes on earnings we have made, but we have not yet paid them. IRS is going to want their money soon, within the next year, therefore current. We have the bonds payable. It says here long-term. Bonds payable may be current, may be long-term. These are bonds that we issued, kind of like a loan, but we issued bonds. And it could be current or long-term. Long-term would probably be your default consideration unless told otherwise. So that means that we're going to be picking these two up for the current liabilities. Current liabilities, we're going to use the sum function to do that. I'm going to do the sum function all with the keyboard to practice that. Equals the sum shift 9, down arrow, down, 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 over, down, holding down shift, down one more, so that we are now picking up the cells B14 to B15, and then enter. So then we're going to say this will be the current ratio. I'm going to go ahead and divide this out to pick up the current ratio. This is going to be equal to up to the 637 divided by up 1, the 426. Now I'm going to format this cell so we can see some decimals. Home tab, numbers group, adding a couple decimals. So it looks, see it's a bit longer of a decimal here, but we're going to round it to 1.5 times. You're always going to have to deal with rounding unless you have a problem that made it perfect, so there's no rounding. But in real life, there's always going to be rounding. So we're going to then go underline this one. We're going to put our cursor here, home tab, font group, underline. So what does this mean? That means that, you know, the current liabilities are, I would think of this one as dividing into or going into, that you can pay over, how many times can you pay over the liabilities with the current assets. So imagining then that the current assets were all cash and that the current liabilities were all due today, how many times over could you pay the current liabilities? 1.5 times. So you want this number to be higher, or higher would be better from a bank's perspective or something like that, because they would think then you're less likely to not be able to pay a debt if they're going to give you a loan or something like that. If you're looking at an investment, you want this number to be reasonably high. If it's too high, you're like, well, why do you have so much, you know, maybe they're not using their assets efficiently, right? But you want this to be high enough that they're not in trouble of not being able to be paying their current liabilities. Now you could restrict this on down further, because you might say, and if you reason through like why these ratios come into play, then it's a little bit easier to think about them. If I was a bank or an investor, I'd say, yeah, well, that's great. You could pay over your current assets 1.5 times. But what if a lot of your current assets happen to be inventory? And what if there's just something bad happens, like some weird thing happens that no inventory is selling at this point in time? Would you still be able to pay off your debt? Could you still pay off the debts that are due soon? Meaning I want something that's more restrictive on the numerator side than simply current assets. I want to break it down to be more restrictive, and therefore I'll call it quick assets, and call this a quick asset ratio. So this is just going to limit the top number so that we can have something a little bit tighter, right? And so I'm going to say this equals the sum of left, down, cash. I'm holding down shift, and accounts receivable, not including inventory. So I'm taking the current assets, but basically removing the inventory. And then I'm going to divide out on the denominator the same current liabilities. I'll sum it up again just so we can see them. Equals the sum, shift 9, left, down, left, down, holding down shift, down once, and there we have it. So now the denominator is the same, the numerator is less, therefore this number is always going to be smaller. Quick ratio always smaller than the current ratio, equals the 343 divided by the current liabilities. Let's go back on over here. We're going to be picking up the numbers, adding 2 decimals. We could keep going. We're going to add it to 2, and then we're going to say that this is going to be the quick ratio. So now we have the quick assets, which we took out inventory, now being less than 1, meaning if all their liabilities, current liabilities, became due today and they couldn't sell their inventory, then just with their other assets, even if they could cash out their receivables, they wouldn't be able to pay the current liabilities, right? The liabilities are higher than their quick assets. So they're dependent on collecting on some of their receivables, obviously, and paying their and then hopefully selling some inventory in order to be able to pay the liabilities that will be due within the year. Now, is that normal? It really kind of depends on the industry. So you want to take a look at the industry to see if that's going to be efficient. And remember, there's a interplay with this in terms of you want to make sure you want to be using your assets in order to generate revenue, but you have to be careful that you don't overextend so that you are in danger, especially in times of an unusual circumstance, in not being able to pay the debt that comes due. And there's an interplay between that, because you want to to use your assets efficiently means they're all going to be used up in order to generate revenue. But you also need to be to not be so efficient in terms of good times that when times are bad, something bad happens, you don't have the liquidity to pay off obligations that become due. Okay, so then we're going to take a look at the debt to total assets. We're going to be comparing the debt to total assets. So remember the accounting equation as you think of this, which is assets equal liabilities plus equity, which you can also write as liabilities minus, assets minus liabilities equals equity. So when you're comparing the debt to the equity, if you have assets are one side of the coin, what the company owns, liabilities and equity represents who has claim to those things, meaning either a third party or equity. When you're comparing the liabilities, you're taking those people that are the third party claims and comparing them to what the asset has as compared to what equity is, the owner's claims, compared to what assets the company has. Okay, so that comparison is going to be total debt. We're going to say total debt. And the debt is going to be including all the liabilities. So that's going to be the accounts payable, the accrued taxes, and the bonds payable. The bonds payable being long-term, that's why it wasn't included in the current assets, but it will be included in the total debt calculation in the total liability calculation. So I'm going to do this with the sum function again, equals the sum, S-U-M, shift 9, down, left, 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 down, holding down shift, down, down, and enter. So there's the 548. Then we're going to be picking up the total assets. The total assets will be summed up for us nicely on the balance sheet. So we'll be picking up the total assets here. And as you look at this, notice, of course, that the total assets on the balance sheet is equal to the liabilities and equity. So total assets, what the company has, is equal to who has claim to those assets, either liabilities, these three accounts, or equity, these three accounts. We're comparing it, the total claim, the total things that the company has measured in dollars, and comparing it with the total debt, third-party claims to those assets. So we're going to say, all right, that's going to be our debt to asset ratio, which is going to be equal to the 548 divided by the total assets. Let's go ahead and make this a percentage. It's typically less than 1, so we can make it a percent to give us a little bit more detail. Go into the numbers, making it a percent, adding some decimals. Again, we could add more decimals. We got to round it somewhere. We're going to round it two decimals out. So we're at 48.67%. So the debt, third-party people, represent 48.6 ownership interest of basically the total assets. And then, of course, you can think about that. You could say, okay, well, that means the equity, if you were to compare the equity would be equal to 1 or 100% minus the 48.68, making that a percent. Equity would then be the 51.33. So the total assets here representing this 1,126,000 is claimed 48.67 by third-party debt, and then the equity represents a 51.33. So you're kind of measuring leverage. How much leverage? Leverage is a term for how much debt compared to the value of the company there is out there. Leverage is a complex topic with regards to finance. It's controversial topic in terms of what level of leverage is optimal. And when should you have leverage and when should you not have leverage and whatnot. So leverage is something that there's constant debate over in terms of how good it is and when you should be applying leverage and how much leverage or debt, in essence, should you have. Okay, so then we're going to have the asset turnover. So the asset turnover ratio is going to be the sales, which will be on the income statement. So we're going to be picking up the sales, and we're going to be comparing that to the total assets. So let's pick up the total assets here again, which will be on the balance sheet. So now notice you're comparing something like, remember up here when you looked at these ratios, we're comparing balance sheet to balance sheet. So we don't have any kind of timing difference issues. These are both numbers that we picked up on the balance sheet. Balance sheet represents where we stand at the end of the year. So they're all, because these are where we stand as of the balance sheet date. not a time frame, not beginning to end, but as of the end of the year. So we don't have to do any funny kind of like thing to try to match up the timing differences as we would if we have, or we might, if we have an income statement account and balance sheet account. These two are balance sheet numbers, no problem. These two are balance sheet numbers, no problem. Now we've got the asset turnover again, where we've got the sales, which is an income statement number representing January through December if we're talking about a calendar year, compared to a balance sheet account, which is a number that represents the number as we stand at the end of the year. And they're inherently different kind of numbers, so there's no way that we can kind of match them up. Remember, we can't really, we can try to take an average, which is more of a representation, but the balance sheet represents a point in time and the income statement represents a time range. So you can't really reconcile the difference. You can just try to do different estimates. So just remember, whenever that's the case, the balance sheet number you might see as represented as average in some way, which the most common average is beginning of the year plus the end of the year divided by 2. Okay, so we're just going to pick up the total assets here that we have on the balance sheet. So we got the sales is going to be the $3,110,000. We're going to compare that to the total assets. And that's going to give us our total asset turnover. So we're going to call that then the total asset turnover. And this is going to be equal to the $3,110,000 divided by the total assets. We're going to go ahead and add some decimals. Home tab, font group, adding some decimals. Again, we could keep on going. We typically stop after the 2 decimals. That shows us or gives us some indication of the efficiency of how well we're utilizing our assets. So we're going to, and again, you'd have to kind of compare this to industry standards and to prior periods to see whether that number is good or not, right? And so we're going to then, let's put an underline here. Let's put an underline here. All right, next one we'll calculate average daily credit sales. So the average daily credit sales. So when we make sales, we're talking about sales on the income statement. And then we often have this issue of collection on the sales. So one, we want to make the sale, but then we want to say, hey, are these people actually paying us on the collection, and when are they paying? How long does it take before we get the money from the sales if we're selling on account? To know that, we got to figure out first then the sales that we make that are not cash sales. Some businesses only make credit sales. All their sales are basically credit sales, so we'll just know that they're credit sales. But some businesses might sell some for cash and some on credit, and then we got to think, well, if it's cash sale, great. We got the money, cash flows in, no problem. Credit sale, I'd like to determine how long it takes for us to get paid so that we can, see if we can improve on getting the money sooner. Would be good for cash flow. So what we're going to do is to do that, we're going to think about, okay, what are our credit sales? And then we can break the credit sales basically to the daily sales to then calculate the average collection period. So to do that, we're going to say, all right, well, the sales are total sales. This is an income statement item, $3,110,000. And we said here that the percent that our credit, we're going to say are about 70% are credit sales. So the percent of the total sales that we're going to say are credit sales are going to be this 70%. I'll make that a percent by going to the home tab, numbers, percent, and then I'll put an underline under it. That's going to give us our credit sales, just credit sales, not percent. And then we'll multiply that out. That equals the sales times the credit sales percent, giving us our credit sales. And now we're gonna take that and divide it by the number of days in a year. Now remember, when you do this, some people might use 365, which is more exact, but it's not nicely rounded into a nice even number of days in a month. And you might say, well, that represents real life. The days in a month aren't even. There's 31, 30, 28. But, when you're trying to do statistics, there might be some times where you want to even things out. So therefore, you might see this number as 360. You might see it as 365. The reason you might see it as 360 is because that would represent 12 months times a nice even 30 days. So we can try to standardize all the months, right? So we'll use the 360 here. That's just something you'll have to deal with. You see 360, 365. You can argue which is better or which is worse or which is right or wrong. It really depends on what you're doing. So then I'm going to go to the Home tab font group and put an underline. Then we're going to have the average daily credit sales calculation then is going to be equal to the total credit sales on the year divided by the number of days. And that'll give us our average daily credit sales. You could add decimals if you want to see some pennies on it, but just notice that you're going to have rounding. I won't do it. I won't put the pennies on it. Probably don't need it in a calculation like this. Once you have that, you can then calculate the average collection period in days, or the average days to collect, basically, on the receivables by taking the accounts receivable. So the accounts receivable, we're going to be picking up then the 303, and then and notice again, you might see something. We're comparing once again something that's on the balance sheet to activity on the income statement, timing difference. So you could see something saying average accounts receivable, most common average, beginning of the year plus the end of the year divided by 2. Still somewhat of an arbitrary number, but again, you might see that as well. So be aware. Then we're going to have the average daily credit sales. Average daily credit sales we calculated to be equal to that 6047. And then that's going to give us our average collection period. The average collection period being equal to the 303 divided by the 6047. I'm going to put an underline here, Home tab font group, and the underline. Now we could do this calculation. Let's underline this while we're here. Home tab font underline. We could do this calculation another way, and it's useful to know because in a test question they might limit the information, and it's good to know this relationship in any case. So another way you can do this. Let's calculate. We'll practice doing this from scratch, formatting this whole thing from scratch. Now I'm gonna calculate the accounts receivable turnover. I'm going to make this, black and white as our headers have been by going to the Home tab font. We'll make this black and white. So there we go. So just black and white. And then we're going to say the accounts receivable turnover is going to be the credit sales that we have calculated. And we saw that calculation for the credit sales here. So let's go ahead and pick that up. We're going to say this is equal to the credit sales. And the credit sales, and we're going to divide that by the accounts receivable. Now, once again, you got sales divided by accounts receivable, so you may see average accounts receivable in some calculations. That would be usually the common average beginning accounts receivable of the period plus the ending divided by 2. So we're going to pick up the accounts receivable, and that's going to be that 303. If we divide this out, this is going to be the 2177 divided by the 303. Let's go ahead and add some decimals. Home tab, numbers group, adding decimals. You could keep on going. We're going to stop it at 2. That's going to be the accounts receivable turnover. Accounts receivable turnover. I'll make this a little bit larger. Let's make it blue and everything so it matches our formatting. It looks all nice. So I'm going to highlight or select these items, right click on them. Going to have the paint bucket here, going to make that blue, and then I'm going to take the borders and we'll make that all borders. Once we have that, we can, whoa, what happened over here? Let's do that again. I'll do it up here. Borders, all borders. All right. Then we can copy this. I'm going to copy this calculation. So the title, this is an alternative calculation for the average collection period, or the days collecting. And we're going to be taking then the days in a year, approximating it at the 360, which again, you might see it as 365, depending on, what you're dealing with. So be aware of that. And then I'm going to be picking up the 718 Home tab font group, adding some decimals to it. That's going to give us our accounts receivable turnover. So we're going to be saying this is equal to the 360 divided by that 718 about, and there's our 50 days again. You could add decimals here, Home tab font, add in some decimals here. You could add decimals here, right? And then I can format this, highlighting or selecting these. Highlighting, it's not the right term, I don't think. Selecting those. But Home tab font, and we'll make it blue, and we'll put some borders around it. Let's put an underline here. put an underline here. It's useful to know the second way. I think this first way of doing it is more intuitive. But the second way is useful because you get to understand the relationship between the accounts receivable turnover and the days collected, how many days of collecting, and you might be forced to do this method in a practice problem where they're going to just limit the data to make you do that.